The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova's presentation of Cash Balance Plans for Advisors with Lisa Pfautz. Before we get started, I'd like to point out a panel. On the top right-hand corner of your computer screen, you're going to see a drop-down section for chat. This is where you will enter in any questions that you may have for Lisa. Just a reminder, or keep in mind that the Q&A portion of this session will be held at the end, and she will answer as many questions as time permits. If we do run out of time and you still have questions, you can send them to our email address, webinars@nova401k.com. Right below chat, you will see a handouts drop down. Here you will be able to download today's material. If you are unable to download the material here, you can go ahead and shoot us an email and we can send that to you. If you are with us today to earn continuing education credits, please be sure to stay until the end to fill out our pop-up survey. This is going to allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce from Nova's Defined Benefit Admin Team, Assistant Team Leader and Actuary, Lisa Pfautz.
Good afternoon. Welcome to the 2024 Cash Balance Plan webinar by Nova Associates. We're hoping that you'll leave this presentation with a great appreciation for the valuable retirement savings tool that's found in cash balance plans. The material may get a bit technical, but I'm going to try to stay as big picture as I can, as any actuary is able to do. The required disclaimer, this is what I'm going to say today is general in nature. It does not a substitute for legal or tax advice. It's always critical to have an attorney, accountant involved if you need legal or tax advice, because we are professional actuaries, but not accountants or attorneys. As Yvette said, here is the provider number for CPA credit, and you need to follow the outline, the items that Yvette mentioned, if you want to get that credit for CPA. We're assuming in this presentation, we've prepared this for those of you that are financial advisors. Some of you are accountants, some are business owners or business leaders who are interested in finding more about retirement plans, and you'll get the most out of it if you have a general knowledge of retirement plans already, such as 401k and profit sharing plans. We're going to cover that to some degree, but our focus is going to be on cash balance plans. Here's our agenda. I'll start out with some introductory information about different types of plans, and then we'll get into the meat of the presentation, which is the cash balance plans. I'll cover a bunch of frequently asked questions, and we'll talk a little bit. We'll just touch on Secure Act, but not so much on Secure Act 2. For those of you that know about that, there's a lot of information out there about Secure Act 2, but that hasn't had a big impact on cash balance plans. Okay, I need to realign my slides here. Just bear with me. Okay, so if I'm talking to a potential plan sponsor, somebody who wants to sponsor a plan, an elevator speech that I could use is you can get an annual deduction of $250,000 to $300,000 But in order to do that, you'll need to give your employees a benefit of $1,000 each plus 7% of compensation. And this is what we're talking about. The largest deductions you can get is in this type of situation. So here's a sample example of it's just an owner who's age 60 with an employee who's age 25. The owner's compensation is right at the IRS maximum compensation limit, which is for 2024, that's $345,000. We could put in place a cash balance benefit of $250,000. They could make their full deferrals and the full maximum profit sharing and get a deduction of $326,500 while giving their staff just the amount shown here. So with the right demographics, 85 to 90% of every dollar contributed will go to the plan sponsor. And some of the samples we look at a little bit later are even more than 90%. So that is the benefit. Obviously, there's still money going to the employees, but it is significantly small percentage of the total amount being contributed. So who'd be interested in these kinds of plans? This is really introductory. You've got your professional firms like doctors, dentists, and attorneys. A lot of our plans are for these types of firms. We've got owner-operated businesses, companies that are transitioning from an older owner to a younger owner, and large companies looking for a defined benefit plan that their employees can understand. The benefits of retirement plans in general, there's that big tax deferral. There's a current deduction for the employer and then a deferral of income taxes on the investment income. So really the benefits are taxed when the money comes out of the plan. And then they're taxed at the ordinary income tax rates. And in some cases, they can actually be rolled over to a personal IRA or to another qualified plan and still continue to defer the taxes. So that's a big picture benefit of these kinds of plans. There's also protection from creditors in a qualified plan, which is a huge benefit. So when we try to help clients, we try to find out more about the company and what their goals are, but we always start with the simplest plans. Simple is better. Simple is less expensive. It's easier to understand. It's more affordable. But we start there and then we move up what I call the retirement plan complexity ladder until we find the plan that is the best fit. Because sometimes more complex is a better fit. But our basic concept is to make it understandable for the sponsor and the employees, because the employees will value it if they understand it. It needs to be affordable, so it has to fit the budget of the sponsor. It needs to be sustainable. We want them to be able to, have this for as long as they want to. And then administratively feasible. If it's too complicated to administer, it's not going to be value to the sponsor. So as we move up the rungs of that complexity ladder, we end up with higher tax deductions and we have more flexibility, but we also have more complexity. So like in anything, you can't have it all. So you're going to get more deduction. It's going to be more complex. It's going to cost a little more. It's going to take a little more work. And when you look at that complexity ladder, the cash balance are at the top of that ladder, the highest level of complexity. So here's a screen just showing a lot of different types of plans, and this is the complexity ladder in reverse order. Can look through those, and when you get to the bottom, which is our highest complexity, we talk about combo plans, and that's a term that I'll use a lot, and that simply means a cash balance plan plus some type of a defined contribution or DC plan, and that's our highest deductions and our highest complexity. And my slides have. Well, so all of these deductions that we're talking about sound too good to be true. And there is, there's a trade-off. So in order to have these higher deductions, there are minimum amounts that need to go to the staff. With a safe harbor 401k plan, that's usually 3 to 4% for just a simple safe harbor 401k plan. And that's because we have non-discrimination tests. And basically a plan or a set of plans can give a large percent of the contributions to the owner or to the HCEs, but there's a limit to how much that discrepancy can be. And so in order to determine what those are, we have the non-discrimination tests. And that's probably one of the most important services that NOVA 401k provides. And that is preparing the tests, communicating the results, and documenting the results, because it's very important for the plans to stay in compliance with the discrimination rules. And I will definitely refer to some of the tests. We're obviously, you can breathe easy because I'm not going to be teaching you how to do the tests. I personally don't perform them to any great degree anymore. But it's very important to know that they have been completed and what the results are. So once we do the non-discrimination tests for a plan that has profit sharing contributions, usually the maximum for employees is 5%, sometimes less than that. With a combo plan where you have a cash balance and a DC plan, a common typical benefit is $1,000 cash balance plus a DC safe harbor profit sharing contribution of 7.5. With really good demographics, that cost can be quite a bit lower for your staff. It really depends on demographics. And when I say perfect demographics, what do I mean by that? That's when you have an older owner and younger staff. So like a 60-year-old owner and staff in their 20s and 30s can get you really good results, giving the staff a benefit, but not having it be as high as 1,000 plus 7%. So I'm going to start back at the basics again. I'm not going to read through this slide. Just wanted to mention this type of plan, the safe harbor 401k, or sometimes we call it a 401k safe harbor. So these plans have a lot of different names, but this is probably our most common plan when it comes to our overall company and what we sponsor or what we provide services for. So in a 401k plan, when employees make deferrals, usually it's put in place because the owner wants to put in as much a benefit as they possibly can. They want to defer as much as possible. But sometimes if they put in the maximum and their employees don't defer enough, they end up having to return those deferrals to the employer, which is not a good thing at all. A safe harbor plan is a plan design where if you have it in place, you can be exempt from testing the deferrals, which we call there the ADP and ACP tests. So the employer can put in the maximum and the employees can do nothing, and there's no ramifications of that, no negative ramifications. And so safe harbor plans are very recommended and very valuable if you have employees in your plan. Owner only, it's not important, but it's really is a very added benefit to a plan. The only drawback to safe harbor is that safe harbor contributions need to be 100% immediately vested, whereas without a safe harbor, your employer contributions, you could do a 6-year graded vesting. So that really is the only drawback that I'm aware of. So here's a simple example. Most people are familiar with this kind of plan, 401k plan with a 3% employer match. The sponsor matches dollar for dollar for the first 3%. We've got the owner who is an HCE and a key employee, relates to top heavy testing. They're making $230,000 and they're deferring $23,000, and then they're getting that 3% safe harbor match. The two non-HCEs are deferring $1,500 apiece, 3%, and then they're getting that 3% match. So you can see there that the 70% of the company's contribution is going directly to the owner. And just to mention, the top heavy minimum doesn't come into play here because it is being met by the safe harbor match. So you don't have any additional top heavy minimums. Just in case we have anybody that's not aware, the acronym HCE and NHCE stand for highly compensated employee and non-highly compensated employee. The distinction between the two is it's not the standard of how you may think about it, but the highly compensated employee is defined as an employee who makes more than $150,000 in 2023. Those would be our 2024 HCEs. So anybody who makes less than that in 2023 would be a non-HCE. So another level of complexity up is when we have a new comparability profit sharing feature or bucket. And with a new comparability plan, instead of everybody getting, say, 3% of pay, we can target specific people. The owner can get a certain percent or certain dollar amount. Your staff, different staff can get different amounts. You really can pick and choose the criteria that you use to give different people different amounts. It's pretty easy to understand. It gives a lot of flexibility from year to year. If you have a good year, you can give, your people that have helped to generate that income, you can give them more, however you want to do it. But with the flexibility comes more testing requirements. And it also brings the gateway requirement. So if we're going to be testing this plan with all the multiple people, the multiple benefits, you're generally going to have to give 5% of pay to everybody in the plan. The allocations in any DC plan there's a limit every year called the 415 limit, and 2024, that limit is 69,000 per participant, unless they're 50 or older, and then the limit is 76.5. So that is the amount, the maximum amount that can go into a defined contribution plan on behalf of any participant. That includes deferral, match, profit sharing. All of the dollars that go in is limited every year, and that generally, that limit goes up with inflation. So here's an example of a new comparability plan. It's the very similar design to the one we just saw. In this case, we still have the deferrals, we still have the safe harbor match, but in addition, we have profit sharing. So now the owner is going to do an additional 46,000 in profit sharing, and we've added the catch up. So the owner is at the 76,500 maximum. In order to do that, we prepare the non-discrimination testing, and the result is that the employees each need to get $1,000 in profit sharing. So they're getting 3% safe harbor, 2% profit sharing, and a 5% total. And the owner is getting 90% of the company's contribution, whereas with the safe harbor 401k without the profit sharing, it was only 70%, I believe. So this is a good example of what we call great demographics, because you've got that older owner with younger employees. Again, ideal, and obviously the results are not as favorable when you have less age discrepancy. So this is just talking about the flexibility that you're gaining with new comparability, and that, as I said before, the safe harbor contributions satisfy top-heavy minimum. So there are two different types of safe harbor, and when you come to us and you get an illustration, we're generally going to recommend not using a matching contribution. And that's not because we don't believe in it theoretically, because matches have been shown to increase the employee savings. So it is a good provision to have in the plan. But there's another form of safe harbor called the 3% safe harbor non-elective. And that basically is the employer gives the 3% regardless of whether the employee makes a contribution. That comes straight from the owner. It's not deducted from the employee's salaries. The reason that we recommend the 3% non-elective is because matching contributions are not considered in non-discrimination testing in most of the tests. So the owner may be giving 3% as a safe harbor match, but they're not getting credit for that when we do the non-discrimination testing. So those percentages are not included for the staff. The 3% non-elective contribution is included. So when you get an illustration back and we've shown you a 3% non-elective for a plan that currently has a match, that's why we're doing it. And it's important to take the plan sponsor's desire into consideration. So we definitely have those who say, no, we really want to keep the match, and that's fine. But we want to make sure that they understand that there will be less favorable testing results. They may have to give more employee money because we can't count that match. The other design feature that we recommend that may not make perfect sense is we recommend not giving the safe harbor to the highly compensated employees, and that's a document provision. The reason we do that is simply flexibility, because there are years where the employer doesn't want to put in as much as they normally do, and if the HCEs are not required to get safe harbor, we are able to minimize the amount that the HCEs get, which helps the testing. And we can always give that same amount as profit sharing. So they're not losing anything. They can the 76.5 is still the max, or the 69 if they're under 50. It would just go into a different bucket. So those are some common provisions that I think are not completely intuitive, but that's why we fall there. I'm not going to spend a whole lot of time here. Traditional DB plans have been around forever, and the most important thing to know about them is that they have mandatory employer contributions. Your 401k, safe harbor, profit sharing plans, they do have some minimal required amounts, the safe harbor, for instance, but the profit sharing is variable and does not have to be made every year, especially for the owner. And you're going to hear this again. You're going to get tired of me saying there are mandatory contributions, and I have a reason why I do that. So a DB plan, or a defined benefit plan, the formula is normally communicated as a monthly annuity payable at retirement, and a typical one is 10% of pay times credited service, and that's communicated as a accrued benefit. Here's an example of a typical benefit payable as a monthly annuity. Someone has 5 years of service. The formula is 10% per year of service. With compensation of $50,000, their benefit is going to be $25,000 a year, beginning at age 65 for the remainder of their lifetime. So it is an annuity, a monthly annuity, or sometimes we communicate it as an annual annuity. And generally lump sums aren't available in these plans. The maximum benefit that can come out of the plan, any defined benefit plan, is $275,000 for 2024. And that is generally that's adjusted for inflation. The amount of contribution that has to be put into the plan is determined by an actuary. And we follow very strict rules from the IRS of how those are calculated. Once we calculate them and communicate them, they are obligatory, and there are penalties for not making the contributions. So let's take a little breather here. And I'm not doing this as a polling question, but you can answer this in your own mind. So who of this list could have the largest defined benefit plan benefit? Elon Musk, Aaron Judge, he's an outfielder for the New York Yankees, and he actually makes about $40 million a year. Or the owner of a small business like a doctor. So who do you think could have the largest benefit out of a defined benefit plan? Well, the answer is that they're all the same. The maximum they could have out of the plan is $275,000 in an annual annuity. And actually that's payable at age 62 for the 415 limit. And it's going to be less than that if it's paid before 62, and more than that if it's over 65. So Aaron, for an example, he's currently age 32, so he would really only be able to get $3,800 a month, which sounds really low, but there's a huge reduction for that 30 years early. So let's get into the meat of the cash balance plan. These are the numbers that everyone gets excited about. And this is a chart showing, this is based on 2024 limits. So a 68-year-old who has had a cash balance plan for 10 years has fully funded it would be able to take out up to 3.8 million out of that plan. Again, this is based on the $275,000 annual maximum. We've converted that into a lump sum. So the 415 limit, remember, is a limit on how much can be taken out of a defined benefit plan, that one-time distribution. And as you can see, the younger someone is, the less they can take out, and that's because we're adjusting that lump sum. Also, if they have less than 10 years, the lump sum would be proportionately less. Another chart that's got the big numbers in it is the maximum annual deduction that could be taken. So a 65-year-old sets up a plan that's as big as it can be. They could be deducting $345,000 a year. And this is just the first year. A lot of times in year 2, the deductions can be 25 to 50% greater. Of course, they are then pre-funding their benefit. You couldn't overfund it for 10 years. So over 10 years, they could do average $345 a year. Now they do need the salary to support this. The 415 limit is a combination of that $275 limit and it is partially based on the owner's compensation. And so they do need the high level of salaries to support this maximum deduction. We often get asked what salary is needed because some employers actually have control over their salary, between profits and salary and what comes out in the W-2 and all of that. And although we're not accountants, we do like to remind people that the IRS does have salary expectations, excuse me, based on the profession of the person. So they might question a doctor who takes $50,000 salary a year. So just keep in mind that the salary should be reflective of the profession that the person is working in. So what is a cash balance plan? Again, this is a bit basic. It is a DB plan. Sometimes it's called a hybrid plan, and it looks and operates like a defined contribution plan, which is what makes it attractive. You can think of it like a guaranteed profit sharing plan because the contribution is guaranteed, it's in the plan document, and the interest is guaranteed because that's also in the plan document. We generally is paid out as a single sum at termination. We have to, there's an enrolled actuary involved, just like any DB plan. And unlike a DC plan, the assets do not typically equal the liabilities. They very rarely equal the liabilities. I think it's kind of interesting. So as an actuary, if somebody terminates employment and needs to be paid out, I don't need to know anything about the plan assets or how the assets have performed. I just need to know what the annual contributions are, what the interest credit is. I need salary history if the benefit is based on pay. but I don't care what the assets are in general. Of course, if you're dealing with a highly compensated person, we do have to look at the assets, but it's very different than a DC plan, because your DC plan, you're going to look how much is in their account. And this really, there's no connection between a person's benefit and the assets. So for a cash balance plan, I'm going to show you an example in a second. So we everything that we do for an account is all done on, I was going to say on paper, but not anymore. We're tracking that. That's something Nova does for your clients or for your plans. We establish that account. We add contributions and interest. When we do the design, we're always making sure that the benefits are staying under that annual annuity benefit that applies to DB plans. We're not limited to the $69,000 that's in the DC. We really can do whatever the document says. So it is, it looks like a DC plan, but doesn't operate that way in a lot of ways. So here's a very simple, well, this is a typical participant statement. They're all this simple. We simply have the account balance at the beginning of the year. We have the interest credit, and that percent is in the document. We have the contribution amount also in the document, and that can vary depending on who the person is. And then we have the account balance at the end of the year. Very easy for employees to understand and appreciate. So here's some sample formulas that could be in a plan, just to give you an idea of the variety. The benefit formulas can really be anything the sponsor desires, and it can target any employees that they want, obviously within the limits of 415 and testing. So sample one type of plan, it could be a percent of compensation for each group, highest for the owners and a smaller amount, 15% for staff. Sample two, we have just a flat dollar amount, which is honestly, that's our most common design because it's simpler. It doesn't vary when compensation fluctuates as much. And in this plan, we have the HCEs that aren't owners are excluded, and that's very common practice. And we do that to avoid the commitment that comes along with the putting it in the cash balance plan is a commitment. So for instance, if the owner wants to give her spouse a benefit in the say $20,000 benefit every year, we would recommend that they do that in the profit sharing plan, and have that spouse excluded from the cash balance plan. They can still give them the $20,000 every year, but in years where things are performing poorly, they can choose not to give it. Whereas in a cash balance plan, if it's in that document, it has to be allocated. So again, that's a recommendation we make and why we do it, but it's not a requirement. It's just we've learned from doing so many of these how to get the optimal results out of a plan for a certain demographic group. All right, so here's our first sample plan, cash balance plan. This is a standalone cash balance plan, which is definitely possible. It's uncommon, but the benefit of having just a cash balance plan is that you only have one plan. You don't have administrative costs for two plans. And this is certainly a viable plan if if the owner doesn't want or need deferrals. So this is the owner. We've got two owners here, and we've got staff between the ages of, well, in their 20s and early 40s, with comp ranging up to 35,000. And again, the owners are at the maximum comp limit, and we give 250,000 each as a credit for the owners, and the staff get 15%. So this gives you an idea of what would be given, and in this case, 94% of the benefits going for the owners. So I think we saw 90% with a new comparability defined contribution plan, but we're getting to 94% with a cash balance plan on its own. It's even better if we added a defined contribution plan. We can test the two plans together using the same testing rules as we do for the new comparability plan, and you're going to get higher benefits and deductions. We're usually going to cross-test benefits. If you don't know what that is, don't worry about it. But when we do cross-test, then we're subject to what's called the minimum allocation gateway. As I talked earlier, for new comparability, that the largest minimum allocation gateway is 5%. That goes up to 7.5% for combo plans. And as we said before, that safe harbor non-elective helps us to pass gateway and our other testing, whereas the safe harbor match does not. So here's a sample combo plan. All we've done is we've taken that cash balance design and we've added a 401k profit sharing plan, a safe harbor 401k profit sharing plan. In this instance, the owners then can get the 250 cash balance, and then they can also get the maximum defined contribution benefit. In order for them to get all of that, the staff needs to get 2% in the cash balance and 7.5% total in the profit sharing safe harbor. So that 7.5% is to meet that gateway that I talked about on the previous slide. So they're getting 9.5% of pay, which is a very generous benefit. But compared to the cash balance alone, the staff cost has gone down by over 10,000, and the owner benefits have gone up by 153,000. So you can see the benefit of the combo in this situation. 97% of the total employer cost is now going to the owners, while still giving a generous benefit to the staff. We've already talked about some of these advantages. I'm not going to go into this. One way I like to think about this plan, a cash balance plan, because we sometimes get hung up on the plan's rate of return. And the way that I like to think about it is, if you have a plan and you've been putting away money, and say you have 3 staff members and an owner, and one of those, and the plan goes to terminate, you're going to pay the staff whatever they've benefited in the plan. Their hypothetical account balance will get paid out to them. And whatever else remains is going to go to the owner. So if the assets have performed more than expected, they'll get more. If it's performed less than they've expected, they'll get less. But the rate of return itself does not have a big impact on the benefits that the owner receives at the time of termination. So I would be remiss if I did not bring up a very big tax advantage about which I know very little, except to bring it to your attention. It's a complicated additional tax advantage when you add a cash balance plan. This is a new tax cut that came out a few years ago, and I really just bring it up to make you aware for pass-through entities. This is a possible additional tax deduction. Here's an example of a plan sponsor, Sally. And when these calculations are done, they involve your personal taxes. So I cannot say enough how important it is to have your accountant personally, directly involved when you're adding these kinds of plans. But in this instance, by adding a cash balance plan with a higher deduction, it made Sally qualify for this QBI deduction, and she saved $100,000 on her taxes. So it's a very real advantage. If you qualify for it, please bring this up with your accountant and get them involved whenever you're adding something like this. The other advantage is some tax credits. There have been credits like this around under Secure Act. They have been beefed up. If you don't know, the Secure Act, it was a act passed in 2019, and it stands for Setting Every Community Up for Retirement Enhancement Act. And it brought in these enhanced small plan startup credits designed to encourage sponsors to sponsor defined benefit and defined contribution plans. And if companies has less than 100 employees, they're eligible for these benefits. They're phased out between 50 and 100. But if a plan has less than 50, there's a three years of startup credits up to $5,000 a year based on how many non-highly compensated employees are in your plan. They also beefed up the tax credits for contributions to a DC plan, and that can be up to $1,000 per employee. Also phasing out over 4 years, or phasing out between 50 and 100, and then phasing out over 4 years. So these credits are important for potential sponsors to know about, because it can really be helpful in covering some of those costs in the early years of a plan. And that is the purpose of it, for Congress to encourage sponsors to help people save for retirement. So these are some of the ways that a cash balance plan is different than a defined contribution plan if you're used to administering those. I've already talked about the required annual contribution, but I have to keep saying it because people either don't hear it or they forget. There are in-service distributions allowed at age 59 and a half. That came in with the Secure Act. But there are funding requirements for an in-service distribution or to pay out somebody who's an HCE, a partner or owner, highly compensated employee. So that is definitely a drawback, and the purpose of that is simply to prevent the plan from, all the funds to be stripped out by an HCE. There is a requirement for a 3-year vesting, at least a 3-year vesting. can't use the 6-year graded like you do in the DC plan. You do need spousal consent to get distributions over $7,000. There's no participant direction. It's all trustee directed. And then finally, there is premiums for some plans to the Pension Benefit Guaranty Corporation. There's an exemption. The PBGC is a pseudo-government agency that insures defined benefit plans. There's exemptions for small professional firms and for owner-only firms. And it costs about $100 a year if the plan is covered. All right, I have a bunch of frequently asked questions. It looks like I'm down to about 10 minutes. So I'm going to go through these fairly quickly to allow time for questions. So these are some of the people, some of the sponsors that we end up setting up plans for. And I'll touch on the first one. So why would a company with a new comparability plan be interested? Or why would we want to target them? And that's because often these companies are already giving 5% or more to their employees. And so they may be able to add a cash balance plan, giving the owners a large increase in deductions and with a proportionally small amount additional for the employees, sometimes not much more at all. If they're already giving 7.5, there might not be an additional cost. So if you are somebody who has a new comparability plan and would like to see an illustration, you could just send NOVA your last year's allocation report and we'll run that illustration for you. So what's the interest crediting rate? As you saw, that's the percent that gets added to the hypothetical account balance every year. It needs to be, it can't exceed a reasonable market rate of return. And then IRS gave us guidance and actually listed some of the rates that would be considered not to exceed that reasonable rate. Generally, NOVA is going to draft most plans with 3 to 5% fixed rate. Can we use the actual rate of return? Yes, legally you can. However, it does lead to undesirable results if the market has any kind of a big swing, like a big loss or a big gain. It's going to have serious technical issues. The non-discrimination testing is the biggest thing because we have to use the interest rate we use for testing becomes variable. And when we're doing this type of testing, having a variable rate is not helpful. If you want to talk about that more, you're welcome to schedule a call with a NOVA salesperson. We're happy to talk through that with you more. Ours is a practical viewpoint in that it doesn't work well with these kinds of plans. So what's compensation for plans? W-2 for sole proprietor, Schedule C, K-1 for partners. Just the thing to remember is that the compensation has to have self-employment taxes paid on it. Otherwise, it's not going to be considered plan comp. Any kind of just straight profits are not considered compensation. And if there's no compensation, there's no benefits. And unfortunately, this is one of those gotchas that we do get plans, but we do an illustration where we think there was compensation and there really isn't. So keep that in mind. Does the plan's investment allocation have to match the plan's interest crediting rate? No, it does not at all. Your clients may want it to be, or they may want to try to beat the rate. But at the end of the day, we We just want the plan to be funded, but not overfunded and not underfunded. So we just want to try to keep it funded. This is just a good example of a investing in 4% CDs, which could certainly be done if you have a very risk-averse client. I'm not going to spend a lot of time on that. And this slide is to show you that you could pre-fund the plan once you're in your second year. Your contributions could be higher. All right, so what can go wrong? We can have unexpected required contributions, and that's what I keep referring to. You know, an employer will say, "Well, I don't want to make any this year," and unfortunately, the answer is you have to, or there's a penalty. We can have not enough compensation. We could be unable to pay out a partner because of the 110% rule. Control groups are always a gotcha. Employee costs can go up because of demographic changes cause the testing to be unfavorable. There are required minimum distributions from these plans. And of course, the biggest unknown is the government agency and their related regulations. The answer is yes. I'm going to let you read that. We don't do a lot of conversions from a cash DB into a cash balance, but they can be done. There is a minimum coverage requirement in cash balance plans. You have to benefit at least 40% of the employees. So if you have a husband and wife with 3 employees, that's 5 times 40%. You can just cover the husband and wife. But once you add another employee, you have 6. Now you have to have one of the employees benefiting. So there is that basic coverage. The minimum allocation gateway, I mentioned that. I'm going to let you read these slides on your own, but that's just some details about that. It is important that the plans be permanent and not temporary. If you want to terminate a plan before 5 years, you want to have a valid business reason for doing that. The SECURE Act allows cash balance plans to be adopted after year end up until your tax return deadline. And for NOVA, if you want to put something in place for 2023, our deadline is coming very soon. So if you have any interest in seeing an illustration for 23, please reach out to a NOVA salesperson as soon as possible. We can still get something done, but it needs to happen very soon for 23. Remember, don't fund the plan until it's adopted, until you get an actual deduction calculation. As a reminder, CPA credit, our provider number is 009820. And with that, we may have 2 minutes for questions.
All righty. It looks like we didn't have any questions come in. So if it's okay with you, we can go ahead and close out.
That's fine with me. I just want to thank everybody for attending today. And as usual, if you have questions, send them to Yvette. Can you give that email address again?
Yep, I will go ahead and do that right now.
Okay.
Awesome, perfect. Well, just a few reminders. On your go-to panel, you're going to see the drop-down for handouts, where you will be able to find a copy of today's presentation in PDF form. If you are not able to see this on your panel, you can email us and we'll send you the handout. For CE credit, be sure to stay to fill out the pop-up survey once the session ends. For any other questions, you can email us webinars@nova401k.com and we will forward that over to the prospective person. To view any webinars you may have missed and the recording of this session, you can always follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you so much, Lisa, for sharing your time and your knowledge with us today. And thanks again to everybody for joining us. We hope you enjoy the rest of your day. Bye.